This is where people tend to panic and start really pushing the narrative of markets in turmoil and stock market crashes. It's going to be an important episode on today's Stock Market Brief show today. We're going to be getting into the expected moves for the remainder of this week. We're going to go over some key levels in the S&P 500 and the Nasdaq 100, revisit these market conditions, and really strategize as what we can potentially expect in the very near term. All that and more. Let's hop into today's show. Welcome back, ladies and gentlemen. Boy, oh boy, it was a wild one today. The Nasdaq composite was down 3.64%. The Nasdaq 100 was down a whopping 3.65%. The volatility index shot up. More on that later, and more on how rare this type of move actually was, not only in the Nasdaq 100, but in the S&P 500. Out of the 11 sectors that make up the S&P 500, we did have some in green. So we did not have a full-blown correlated state to the downside. It was clearly a risk-off day, not only by price action, but you can see the sectors that were leading the way happened to be utilities, healthcare, consumer staples, and energy, right? These utilities, healthcare, consumer staples are typically the ones that are more of the safety type trade. So when you take a look at the heat map, you do see a lot of red on the screen, but you do see pockets of green. The big red squares are the large market cap names, where we had Google report earnings. It was down 5%. NVIDIA down 6%. Obviously, a very important name. Now, if we take a look at the days since we've seen a 2% decline, well, we finally had it. It was 356 days of not seeing a 2% down day in the S&P 500. How rare was that? Well, we'll get into that. The last time we saw that was a 351-day streak, and prior to that was going into the Great Financial Crisis, 949 days. Now, if we take a look at how rare this move is on the SPX, let me just point out there's 1, 2, 3, 4 levels here. What are these? This is the standard deviations of what the market priced in as far as implied volatility. This was a one standard deviation move, right? 68% of the time, it typically closes in and around these levels. This was a 2 sigma move. This was a 3 standard deviation move where price started to kind of hanging around there, okay, for the majority of the trading session. Then this is the 4 standard deviation move, which we closed just underneath. Now, just to give you a perspective on this, a 3 sigma move, right, you typically close within a 3 sigma range, which would mean above this 3 line, 99.72%. So what is the likelihood of the 4 sigma move? Well, it's 0.0064%, right, that we close outside of it, which means there's about almost 100% probability that we close within a 4 standard deviation move, and we close basically on it to slightly outside. So very rare day. And if we looked at market net flow throughout the course of the day, this would have told you to be pretty much on the sidelines and or to the trade to the downside. Why? Because we've had the red line above the green line. The red line was basically going up through the majority of the day or to sideways. And then the green line, which is the cumulative net premiums for calls, was going down. Then you look down here to the convergence indicator and you see that it was basically red, meaning price action is moving with the flow of the market. And that is the bearish type of trend day that you would expect. On the flip side of this, if you see the green line above the red line and this green, it's a trend day to the upside. Now, we talked about how this kind of was a split screen, quite a bit of red on the screen, but you see pockets of green. And what you see pockets of green in is potentially more value type pockets. And I thought this was kind of interesting. I often look at the ratio between growth, right? Growth and value. What does this mean? It means when this line goes up, means growth is outperforming value stocks. And not too recently, we actually came into a matching high of where we've seen since 2001. So growth went on a monster run relative to value. And now we're starting to see that kind of back off from these all-time highs. And what I found interesting here is if you apply that 10-period rate of change, this thing is down at 9.22%. And I had to go back through history to say, whoa, when's the last time we've seen that steep of a rate of change to the downside in this particular relative strength line? And you can see we actually haven't seen that since about 2001, which happens to coincide aligned with when we started going through the rate cut cycle and the yield curve started to uninvert. Now, I don't think you can use this as any tool whatsoever to time anything strategically, but I did find it kind of interesting just to see where we were the last time that this type of move has occurred. So, I mean, that's a big move, right, into value versus that escape out of growth. Now, if I take a look at the 10-year, 2-year yield curve versus the S&P 500, what we've noticed since we've been inverted was when we go deeper into inversion, meaning farther away from the zero line down, right, the S&P 500 is actually rallied, right, down, 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 rally, 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 rally. It's not until the yield curve begins to uninvert where we actually saw a 10% correction, or the yield curve starts to uninvert and we start to consolidate sideways, right? Yield curve kind of chops around sideways to go higher. We pulled in a little bit. And just recently I shared this chart where the S&P 500 was up here and the yield curve was also uninverting, and we kind of highlighted this and we're like, something seems a little off here. Typically, right, is this correlation going to go back and change? Or is this correlative going to go back into what we've seen in the past? And the idea here was if we begin to uninvert further, this could put pressure on the S&P 500 or have it begin to digest. And that is what we're seeing. Now, the yield curve, the 10 and 2, is at minus 15 basis points. And we actually haven't seen this, high of a yield curve or closest to an inversion since, I think it was actually technically July of 2022. So I checked here, and I'm pretty sure it was higher than this point too as well. So July of 2022, as we're kind of getting closer to potentially uninverting here in the near future. What do we got on deck for the remainder of the week? Well, today after the close, we had Chipotle, which made a monster run. That kind of reverted itself and it's back up a little bit. Ford earnings came out. Those were down. We had obviously Tesla and Google. Both were down on the trading session today. For Thursday, right, we have American Airlines, we have DXCM, Skechers, and then on Friday before the open, we got Bristol-Myers Squibb and 3M. So pretty much, light for the most part as far as that goes. But as far as macro reports go, we do got tomorrow morning, an hour before the market opens up, GDP and durable goods. And then Friday, we get personal income, personal spending, and core PCE. So what can we expect? Well, let's take a look at expectations for the market. And this is implied moves that the market's pricing in. Now, remember, right, you can have outsized days. This was a very rare day, so just keep that in mind. In this, you can screenshot it. It's something that I share with my Discord group or Patreon, which is linked in the pinned comment or in the description. If you want to join, I do give a lot more than just the expected moves. We have all kinds of stuff for $9 a month or just pay for the year, and it ends up being like $7 a month. So like $90, you get to be in there for a year. Okay. Here's the 2 sigma levels right here. You have the upper, lower, and then you have the daily, the 68% of the time it closes within these ranges. And let me just be frank here. The SPX expected move today is 49.79. This is actually quite a large expected move. Yesterday's expected move for the SPX was 31.76. So we're talking, 30, 40, 50 to almost $20 more for the implied move. So this is now pricing in a lot more volatility. You can see the SPY has about a $5 expected move. These are moves that you'd sometimes see a price in for an entire week. And I'll talk more about volatility here soon. Okay, Q's $5.89, and then IWM, it's back up to $3 for the expected move. Let's take a look at the S&P 500. We'll get into some volatility, and we'll talk about some charts and some key levels. So first and foremost, we'll look at the weekly chart. Now, the weekly chart, we're seeing some more red. We're down 1.41% on the week, getting below that weekly 5 EMA, which is starting to turn around. Now, we talked about the bearish weekly candles on the last video on the NDX and the S&P 100. This bearish outside day is currently getting some more continuation to the downside. This can still obviously mark a turning point in the markets, and it negates it the moment that we cross above the high of that week. Okay, if we take a look at the S&P 500 on the daily time frame, we are pulling into an area of confluence to be aware of. It's the 50-day moving average that is inclining and the lower Bollinger Band level. However, I think we should make note that below us, which is roughly about 5375 to 5400, we have this gap within the S&P 500. So if price wants to come down further, if we close these windows, these gaps, they can act as potential levels of support. And then we may get some sort of a bounce. Now, there's a couple of things here. Somebody had asked me, do you see a bounce happening tomorrow? And this is the interesting part about seeing a big bearish day like this, right? So you have a huge range candle. Typically, you can get gaps up and you have inside trading days the next day. That is very common. However, what's also very common is when you close at the low of the trading session, it's very common to have some follow through too. So as it stands right now, I'd say be very careful here. Now we got to go into some more key levels and talk about probabilities. Okay, so more on specifically that gap level, which is right down here. I'd also note that the daily expected move is 536.13 on the S&P 500. Now below that is actually this anchored volume weighted average price, and that is from the prior pullback that we've seen from this swing low, and that could be a level to potentially key in on if we get some more continued sell side, and that lines up closely to the lower month-to-date expected move there too as well. So in and around these areas, we may be able to see a potential bounce. Okay, but we're just not like we haven't seen vicious sell side really. I mean, yeah, it was a 2% down day, but we're talking a few days separated from the swing high. If we take a look at the 15-minute time frame, we do have a positive divergence in the RSI, just like we did over here, and we saw a little bit of a bounce. Now, this bounce was what? It was a bounce within a downtrend, right? You see the high, you see the lower high. We saw this low, and we cracked through this low to make a new low. So the trend right now is lower highs and lower lows, and the 5-day moving average is still declining. So even if we bounce, it is a bounce within that downtrend as it stands. We did click through and tag the lower weekly expected move, so the higher probability is that we close within this range. We came all the way up to it this week. We came all the way back down. If we start getting back outside of it, right, there's a probability that we just trade in and around this lower weekly expected move. Another note here is back month first, front month volatility. And back month first, front month has came off quite a bit. It's not down towards the one level, which, in the past, when we've gotten down to these levels, it showed that the market started to find a bottom and then eventually kind of bounce. Not all the time, but you can see even here, kind of stumbled around sideways, went a little higher, and then went down. We started getting through it in this range too as well, and it started to find its bottom in and around here, and then over here too as well. We came close, and that found the bottom there too. The last time it was down at these levels was roughly right around here, where the market kind of stumbled sideways and found its bottom there shortly after. So if we do start moving down further here from back month to front month, it could mark a potential area where price starts to calm down and potentially bottom out. Now, we were talking about volatility earlier, shooting off like a rocket ship, and so much so that we've actually now, according to VIX term structure and CBOE, we have went into backwardation, which means our front month over here, August, is now ahead of our September contract. And in short, if you're in contango, it's a curve like this where you're looking out to the future, it goes up, and it's basically telling you there's the possibility of risk. Yeah, there's always going to be a possibility of risk out in the future. But what this tells us right here is, hey, the risk is here right now, and it's more so than what we see in the very near future. So what does that mean? It means that we can potentially continue to see, obviously, more volatility, and we're seeing that within the implied moves as it stands in this current moment, how they've expanded so much in a matter of a day. Now, as far as the gamma flip line, that's at 55.70, and one thing that we know is when we're below the gamma flip line, this is where selling begets selling and buying begets buying. And well, what is this? This is selling into selling. This was straight down, no bounce, no nothing today, into an area that we haven't actually seen since July, right? This is July round trip, right? July started right here. We went up, we came right back down into this level. And this level over here, this box, is something that we highlighted when price was about right here. And we were talking about just how important of a level it was, because that's where the gamma flip line was at that specific time. And you can see price ended up getting back above it and getting a little bit of a gamma squeeze to the upside. Now, I want to see if price has some memory, so I'm drawing this back out. We came into that 54.50 level, okay, which happens to be a put wall for the day it was. And now it's actually a pretty important put wall for the structure of gamma too. So if we do start getting a bounce, maybe keep an eye on that 5,500 level. And if we continue to go up, obviously we'll update to see where that gamma flip line is. But we're below a declining 5-day moving average. We're in negative gamma territory. So any bounce should be treated as just a bounce within a current downtrend until what? Until we're back in positive gamma territory. And when we have back a rising 5-day moving average or flattening, right? Right now, it's clearly declining. So maybe perhaps we do bounce, right? And comes back and whatever does around, the 5-day moving average starts to flatten out. And at that point, we start to look for it to turn up and opportunities. Then, if you want to be more patient, there's no reason why you can't be tactical and play various bounces. But if you want to be patient and put on some size and, play with the trend, which is typically easier to do, you'd want to be more patient and obviously wait. Let's take a look at the Nasdaq 100. We talked about this 3-bar reversal pattern. We are getting continuation to the downside, albeit it's quite extended, including from the price action that we saw today. So we'll see how the week closes. Okay, a lot of the times, right, it's very common to see back tests if we break down a back test. And if we back test, where would that bring us? Probably to 19,500, which is into a declining weekly 5 EMA. Very common when you get very extended from the weekly 5 EMA, you can get snapbacks, and it goes both ways. We got really extended, we saw a snapback. We got really extended here, and we saw a snapback. We got extended here, and we kind of went sideways until price action kind of caught up, and then we got that extension. So right now we're getting, once again, pretty extended, but there's, that doesn't mean that we can't obviously stop. I'd say 18,900 to 19,000, this range in here, right, where we had prior highs and this prior low. Yeah, it could be a potential area where we get a little bit of a bounce, sure. But let's take a look here at the cues on the daily time frame, and you could see here we did also pull into the weekly expected move, and we're about there at the monthly lower expected move too. If we get continued downside, look at the lower daily expected move, roughly at 457.49, and that is pretty in line with the prior swing low anchored VWAP from this level. And actually, this is what Brian Shannon calls a handoff of the anchor volume weighted average price. And basically what we do is from this, bear market low, not bear market, it was a 10% correction or whatever, some of this correction low, you anchor a volume weighted average price. We saw a move from that, and we didn't tag it until we saw this pullback in here. And then now we're just handing off the anchor volume weighted average price to here. And you can see price is kind of coming back into and around that range from a pretty strong move. So yeah, to pull back in a little bit, to see a little bit of a bounce, and then, establish where the 5-day moving average is from that standpoint, totally makes sense. Okay, take a look here. We're currently outside of, obviously, that weekly expected move, basically trading on it. Positive divergence on the RSI, 5-day moving average, right? We bounced, right, into a declining 5-day moving average. We continue to the downside, right? When we're in negative gamma territory, when we have a declining 5-day moving average, it's very simple, people. Volatility typically increases, right? We're seeing that in the term structure right now. Volatility typically increases, liquidity dries up, and you see much more violent moves in the market. Hope today's episode helped out. If you haven't done so already, make sure to check the pinned comment for a link to Interactive Brokers, which has a bunch of cool tools, free resources, great brokerage. I trade on them, trade on a couple platforms, but IBKR is one of my main platforms. And then also the link is to the Patreon, and within Patreon, if you do the $9 a month or the pay for the year, you get access to the Discord and all those various benefits. Hope that helps. See you later.